You paid taxes last year. Maybe 22%, maybe 24%, maybe 32%. You watched it leave your paycheck automatically before you touched a dollar. Now consider this. Jeff Bezos' net worth grew by $99 billion between 2014 and 2018. His taxable income? $4.2 billion. The remaining $94.8 billion was never taxed. Not once. Source: ProPublica, IRS data. That is not a loophole. That is not an accident. That is a system working exactly as designed. The tax code does not treat income equally. It treats your income the worst. Here is what they do not teach you in school. There are two types of income in America. Earned income, the money you work for. Unearned income, the money that works for you. The tax code taxes these two types of income completely differently. And the difference is not small. Your salary, taxed at 10%, 12%, 22%, 24%, 32%, 35%, or 37%, depending on how much you earn. Long-term capital gains, the income the wealthy live on, taxed at 0%, 15%, or 20%. Maximum. If you earn $80,000 from a job, you pay 22% federal income tax on a large portion of that. If a billionaire earns $80,000 from selling stock held for over a year, they pay 15%. Same amount, different rules, different outcomes. But it gets worse. Because the salary comes with another tax, most people forget to calculate. FICA, Social Security, and Medicare. 7.65% taken directly from your paycheck every pay period on every dollar earned up to $176,100. Your employer pays another 7.65% on your behalf. That is 15.3% of your labor before federal income tax even begins. Capital gains? Zero fica. None. You're not just taxed more. You are taxed at every layer. They are taxed at one. Here is the part that makes this system invisible to the people it affects most. The IRS publishes data on who pays taxes. And on the surface, the numbers look progressive. The top 1% of earners paid 38.4% of all federal income taxes in 2023. Politicians use this number constantly. It sounds like the rich are carrying the burden. But that framing hides two critical facts. Fact one, the income being taxed is only reported income, not all income. IRS audit data shows 1% of wages go unreported, but 12% of business income goes unreported. 18% of capital gains go unreported. 53% of rents and royalties go unreported. The types of income that flow to the wealthy are the exact types most likely to be hidden, not by fraud, by legal structural invisibility. Fact 2. The largest wealth accumulation in America is never taxed at all. Not deferred, not reduced, never taxed. Unrealized capital gains, the increase in value of assets you have not yet sold, are not considered income under U.S. tax law. Zero tax liability until the asset is sold. Bezos' stock grew $99 billion. Taxable income, $4.2 billion. The other $94.8 billion existed. It compounded. It built dynastic wealth. And it was taxed at 0%. High voltage pattern erupt. Consider, a salaried worker earning $75,000 has 100% of their income visible to the IRS. A billionaire may have 5% of their true economic gains reported. There is a third layer that operates below the federal level, and this one is explicitly regressive. The poorest 20% of Americans pay an average state and local tax rate of 11.3%. The top 1% pay 7.2%. State sales taxes, property taxes structured by geography, fees, excise taxes on necessities. The less you earn, the higher the percentage of your income consumed by these taxes. This is not accidental architecture. This is the outcome of 50 years of policy choices. The system is not broken. It is performing exactly as its designers intended. The 1% understands something the middle class is never taught. The solution is not to protest the tax code. The solution is to understand it structurally and then position yourself inside its logic. There are 4 moves. executed in sequence. Over time, move 1. Shift income type from earned to unearned. Every dollar you earn from a job is taxed at the highest possible rate. Every dollar you earn from an asset held over 1 year is taxed at a maximum of 20%. The first strategic move is to build assets that produce unearned income, dividends, capital gains, rental income, and reduce dependence on salary income over time. This is not retirement planning. This is tax architecture. A household earning $95,000 in salary pays roughly $16,000 to $18,000 in federal income tax plus FICA. The same household earning $95,000 from long-term investments pays $14,250 maximum and zero FICA. That is a $3,750 to $5,500 annual difference. Move 2. Understand tax-advantaged accounts as structural tools, not retirement savings. The middle class treats a 401k as savings. The wealthy treat it as a tax deferral mechanism. The difference is critical. Contributing to a traditional 401k reduces your taxable income dollar for dollar. If you are in the 22% bracket and contribute $23,000, the 2025 maximum, you reduce your tax bill by $5,060 immediately. 401k contribution limit 2025, $23,000. Catch-up contribution if over 50, additional $7,500. Total possible, $30,500. A Roth IRA operates differently. You contribute post-tax dollars. Growth and withdrawals are tax-free. For a 30-year-old earning $75,000, choosing between traditional and Roth is not a preference. It is a calculation based on projected future tax rates. Most middle-class workers never run this calculation. They pick the default. The default is rarely optimal. Move 3. Use losses strategically, tax loss harvesting. This is standard practice for every wealth manager serving high-net-worth clients. It is almost never discussed with salaried workers. When an investment loses value, you can sell it to realize that loss. That loss offsets capital gains elsewhere in your portfolio. If losses exceed gains, up to $3,000 of that loss can offset ordinary income per year, with the remainder carried forward indefinitely. The wealthy systematically harvest losses. The middle class panics and sells at the wrong time for the wrong reasons. Timing is not just strategy. In tax loss harvesting, timing is money. High voltage pattern interrupt. Tesla earned $2.3 billion in U.S. profits in 2024. Federal income tax paid, $0. Effective tax rate, 0%. Move 4. Understand the step up in basis, the mechanism that erases taxation at death. This is the most powerful and least discussed tax provision in the U.S. Code. When you inherit an asset, its cost basis resets to the market value at the time of inheritance. Any gain that occurred during the original owner's lifetime is permanently erased from the tax calculation. A parent buys stock at $10 per share in 1980. It is worth $500 per share at their death in 2025. The child inherits it at a $500 basis. If they sell it at $510, they owe capital gains tax on $10, not $490. $490 in gains. Never taxed. Legally eliminated. This is how dynastic wealth compounds across generations. Not through fraud. Through code. The middle class builds wealth. The wealthy transfer it, tax-free. Here is a number most people have never heard. Yale Budget Lab estimates that recent IRS funding cuts will result in $861 billion in uncollected taxes over the next 10 years. The majority of this gap is taxes owed and not paid by the wealthiest Americans. $861 billion. Not hidden, not in offshore accounts. Legally owed, structurally uncollected. Meanwhile, the IRS audits low-income households, claiming the earned income tax credit at rates comparable to audits of millionaires, because those audits are cheaper and easier to process. In 2024, the new tax law is projected to cut household resources for the bottom 10% by 3.1% annually through 2034, while increasing resources for the top 10% by 2.7%, or $13,600 per year. This is not partisan framing. This is the CBO's own projection. The direction of wealth transfer is visible in the legislation. The architecture is public. Most people never read it. The policy is written in plain language. $861 billion confirms it works. You were never meant to read it. The architecture is public. Most people choose not to read it. The tax code is not neutral. It was written in a language designed to be unreadable, and it rewards those who learn to read it. Salary income is the most taxed form of income in America. Capital gains are taxed at half the rate. Unrealized gains are not taxed at all, and a step up in basis eliminates taxation permanently at inheritance. The system is not designed to help you accumulate. It is designed to extract maximum value from earned income and protect accumulated capital. The 4 moves we covered: shifting income type, maximizing tax-advantaged accounts, harvesting losses strategically, and understanding the step-up in basis. These are not tricks. They're the architecture the wealthy use systematically every year. Now I want to know where you are. Comment 1, 2, or 3. 1. I'm still 100% dependent on salary income, and I have no investment assets producing unearned income. 2. I have started shifting to investment income, but I have not optimized my tax structure yet. 3. I already understand these mechanisms, and I am actively deploying them. Comment below. The answer matters because the next video we build depends on where most of you actually are in this process. The code was written. You are not invited to the table. Start reading the code.